we are going to start with the foreign exchange exposure and risk management, a revision class for this chapter. Before we begin, let us look at the various concepts and terms which are used in this particular chapter. So, what is American quote and European term? What is direct and indirect quote? What is bid offer spread, cross rates, PIP or the price interest point, forward exchange rate quotation, forward point determination, and broken period forward rate. So let us look at some basic concepts first, and then we will deep dive into the concepts. So let us start with what is an American term and a European term. Now, this chapter has very much weightage, so one has to be very careful in attempting the questions related to foreign exchange. If it is an American term, it means that the contract can be executed in terms of the US currency being the direct quote. So when we talk about the exchange rate or exchange quote, it is expressed with a reference currency. So if I say $1 is equivalent to, let's say, 92 rupees today, this is the exchange rate where rupee 92, rupee is the reference currency with respect to dollar. So the price of $1 with respect to rupee. And for Indians, it is a direct quote we have rupee fluctuating here. So we have rupees fluctuating and $1 is just like a commodity. So the price of $1 is how much rupee? This is direct quote for us Indians because our home currency is rupee. But for US citizens, it is indirect quote. Now this quote is a European quote. Any quote which is direct quote for Americans is a American quote. That is called as American quote. Okay. So what is the exchange rate? How many rupee is required to get $1? This is a direct quotation for someone in India because for India, home currency is rupee and therefore it is a direct quotation for India. Whereas it is also a European quote because it is indirect for Americans. If it is direct for India, it is indirect for the American citizen. So what is the exchange rate? How it is determined? It is determined with reference to the price of 1 unit of a currency or a foreign currency with respect to our home currency. And then it becomes a direct quotation for the home currency. To continue, if this price was taken as 1 rupee is equivalent to how many dollars? So it becomes, for example, here 92 is the price. So for indirect quote, it will become 1 divided by 92. So the price of 1 rupee is equivalent to 0.0 direct quote for India. But for Americans, it is a direct. For US citizens, it becomes a direct quote. Okay. Therefore, we can say that it is a American quote also. So any quote which is a direct quote for Americans is a American quote and rest all are European quote. Why we call it direct? Because for us, it is very easy to understand that if we want to see that how much rupees are required to buy 1 euro, $1, £1, one Swiss franc, for all of us, because it becomes direct quote. Because when rupee fluctuates, which we are comfortable in, we can easily understand what is the price of the other currencies. Therefore, it is direct quote for Indians, but indirect for others. Similarly, for Americans, when the 1 rupee is quoted as $0.01808, then it is they are comfortable when the USD moves. When USD fluctuates, they can make the price of 1 rupee, £1, €1. That becomes a American quote, and rest all are European quote. So to note out the crux, any direct quote for Americans is the American quote, and all others are called as European quote. This must have made it clear what is a direct and a indirect quote. So if our home currency is rupee, 1 unit of other currencies expressed per in terms of rupee becomes the direct quote. If we are given a direct quote, it can also be converted into 1 upon direct quote, and that will become your indirect. So firstly, we have to understand foreign exchange, how it is quoted in terms of other currencies. But sometimes it happens that you may not get the price of dollars directly with rupee, or let's say if we have rupee 92 is equal to $1, that's one quote in terms of USD INR. Similarly, you can have euro versus INR. So 1 euro is equal to how much INR? Let's say 110. Okay. So 110 rupee is equal to 1 euro. Now, if we want to find out what is the price or the exchange rate of USD equal to 1 euro is equal to how many USD? So how we can calculate that? We don't have a direct quotation for USD versus euro. Therefore, we can use the cross rates. So you want euro, USD and euro. These rates are given and we want the euro on the denominator, which we have. So this we will use directly. This we will reverse. So 1 upon 92 multiplied by 110 by 1. That will give you the price of USD to euro. So 110 divided by 92. The price of 1 euro is 1.1956 USD. This becomes a direct quote for US and therefore also the American quote. Had I calculated euro upon dollar, then it would have been 92 divided by 110. This comes out to be 0.8363. This becomes a direct quote for a European citizen or Euro nations, and it's also a European quote because it is indirect for the American. So this is how you calculate the European quotes. But what happens in the market is that we don't have just one single rate. We have bid and ask. Bid is the rate at which the banks will buy from the merchant. And ask is the rate at which the banks will sell the merchants. So anyone who needs currency, let's say an exporter, importer, they will all need currencies. Exporter will need a currency because he will receive foreign currency. So he will sell this foreign currency to the banks and get it converted into rupee. An importer will need foreign currency because he needs to pay in foreign currency. So he will buy from the banks and then he will make the payment to the foreign party. Now the importer has to buy, so bank will sell him to this importer. For the importer, ask rates are applicable, and for the exporters, bid rate will be applicable. Always remember, bid will always be less than ask. So if we were given rupee by dollar as 92.10 oblique 92.15, then if someone wants to buy dollars from the bank, they will have to pay 92.15. So the ask rate will be applicable. Here, bank is selling at 92.15. And if you want to sell the currency to the bank, you will get 92.10. This is the price at which the bank will buy the currency from you. Bid rate would be applicable. So obviously, when the bank will sell, it will sell at higher price. And when the bank will buy, it will give you less price. This difference of bid and ask which is here in this case 92.15 minus 92.10, which is equal to 0.05. This is called as spread. So spread is the difference between bid and ask. You may also calculate in percentage. What is the spread percentage? It is bid minus ask divided by bid. So 0.05 divided by 92.10 is the spread percentage. The spread percentage is 0.0542%. So these are some of the terminologies which must be clear, that what is a quotation, how exchange rates are mentioned, and how you have to calculate the bid rate, the ask rate. What is the difference between the two? It is a spread, and how spread percentage is calculated. What is a direct quote? What is an indirect quote? Further, what is an American quote and what is a European quote? Now, if you are given both bid and ask, then if you want to convert it into indirect quote, you have to remember that 1 upon ask oblique 1 upon bid would be the indirect quote. So 1 upon 92.15 will become the bid, and 1 upon 92.10 will be the ask when you want to convert it into indirect quote for Indians. So these are some of the terms which we have taught. So I hope you've understood what is American quote and European quote, direct and indirect quote. What is bid, offer, or spread? Offer may also be called as ask. And how do you calculate the cross rates? The next talk we talk about is PIP, which is the price interest point. So the smallest unit by which the currency quotation can change. If I write $92.15, $1 is equivalent to rupee 92.15. Then here the PIP is 0.01. Because next what can happen is the price of dollar can also become, the minimum amount it can change is 92.16. So it's changing by 0.01. Or it can become, if it goes depreciate, it becomes 92.14. So 0.01. If I had made the quotation of $1 as 92.1567, then the dollar PIP would have been 0.0001. So the 4 decimals by which it can change now is 92.1568 if it increases or at premium, or 92.1566. So by how much it has changed? 0.0001. So this is the price interest point, or the smallest unit by which the currency quotation can change. So generally it is expressed in 2 decimals. However, in India, the dollars are quoted up to 4 decimal places. So this is about the basics in the foreign exchange. Now we have a concept called interest rate parity and purchasing power parity. So interest rate parity talks about that if the interest rates in India are 10% and the interest rates in US is just 2%. So if the spot rate represented by S is equal to $92.10 rupee per dollar, what would be the forward rate? So RD is the rate of interest in domestic currency, which is 10%, and RF is the rate of interest in the foreign currency. Which is 2%. So it is per annum. If I want to see what is the rate of interest of the forward currency, how the exchange rate will change from 92.10 per dollar if the rate of interest in the 2 countries are different. So interest rate parity theorem says that nobody should be able to take the benefit of the interest rate differentials. So as the US currency is giving lower rate of interest, the exchange rate will be in favor of the US currency. So here the US currency should be in premium. Whatever the loss of interest is should be compensated by increase in the price of dollars. So the new forward price can also be given as spot rate multiplied by 1 plus rate of interest in domestic currency divided by 1 plus rate of interest in the foreign currency. So it will become 92.10 into 1.1 divided by 1.0. So the new forward rate should be 92.1 multiplied by 1.1 and divided by 1.02. So the exchange rate will change to 99.32. So this is called as the interest rate parity. So for goods, wherever you have the country which has less rate of interest, that price, that country will have premium on the currency. Similarly, we have a purchasing power parity, which talks about inflation. So when we talk about inflation, it says that the price of different goods or a basket of goods can be increased at different rates of inflation. So if inflation in India is 6% and in US the inflation is, let's say, 2%, what would be the price or the exchange rate of $1 after 6 months? Now, this time I'm taking after 6 months, and these inflation rates are also per annum. So after 6 months, if current price is rupee versus dollar is 92.10, then after 6 months with purchasing power parity, it should be spot multiplied by 1 plus inflation in India divided by 1 plus inflation rate in US. So here 92.10, 6% for 1 year. So after 3 months, 6 months, it would be 1.06. 6 divided by 2, 3% for the 6 months period. Similarly, 2 divided by 2, it will be 1% for the 6 months period. So 1.03 divided by 1.01. So after 6 months, the price of the US currency against Indian rupee would be 92.10 multiplied by 1.03 and divide by 1.01. It would be 93.92. So the price of US currency would increase. This also means that the US currency is at premium. So once again, the country which has lower inflation, that country currency would be at premium. If US currency is at premium, the rupee is at a discount. So this is how you will calculate the forward rates. Forward rates are the rates which is not for today, not for the spot, but for some period in the future. The exporters and importers, they both need to settle their contracts in future. So maybe an exporter has to receive payment. So it is possible that exporter receives a payment after 3 months. Our importer may have to pay after 6 months. Therefore, forward rates are very important. These both parties, they are exposed to foreign currency risk. Because if the dollars, euro, or pounds, if they fluctuate, the exporter will receive different amount than the time when he has entered into a contract. So he doesn't want to take any risk. He can enter into a forward contract. So he enters into a forward contract to protect himself from exchange rate fluctuation. And he enters into forward contract to sell the foreign currency, which is a bid rate. Similarly, the importer has to pay after 6 months. So he fears that the price of the foreign currency may not increase. Therefore, he also will enter into a forward contract to buy the currency after 6 months. So for him, ask rate would be applicable. So banks will sell the foreign currency to these exporter or buy the foreign currency. So from exporter and importer, when the bank buys the currency, the bid rate is applicable. And when bank sells the currency, ask rate is applicable. So today's spot rate may be, let's say, 92.10 oblique 92.15. But the forward contract could be if we expect the dollars to be at premium, looking particularly at the interest rate, which is less in US, or the inflation, if it is less in US, we'll expect the US currency to be appreciating and US currency to be at premium. In that case, the forward price could be, let's say, 92.80 and 92.95. So the price has increased in both the bid as well as in the ask. By what points has the price increased in forward contract? So from 92.80 and 92.10, the difference is 70 or 0.70. Whereas here, the difference is 80. So if it is increasing from left to right, you can see that these are the US dollar is at premium. And forward contracts or rates may not be expressed in exact what is how many rupees per dollar. They may be expressed in terms of forward points, or they may also be called as swap points. So if I have given the quotation for today as 92.10 and 92.15 bid and ask, and if swap points are given as 70 and 80, I'll add 70 paise to 92.10 and 80 paise to 92.15 to reach the forward rate. If swap points are given as 60, 80, then what would have been the new forward rate? It would be 92.70 oblique 92.95. When they are increased from left to right, you have to add the swap points to the spot rate so that the forward rate can be determined. However, if swap points were 80-60, then what would have been the new forward rate? It would have been 92.10 minus 0.80 and 92.15 minus 0.60. So new exchange rate would have been 91.30 oblique 91.55. So you have to look at the swap points. If it is 60-80, it's increasing from left to right. You have to add to the spot. And if it is 80-60, you have to subtract from the spot. If it is increasing from left to right, that means the dollar is at premium. If it is decreasing from left to right, that means dollar is at discount. So this is how you find out the forward rates. They may be expressed as forward points. It also important to see what is the PIP here or the price interest points that is relevant. If the points had been 70-80 and the spot rate would have been given as, let's say spot was given as 92.1025 oblique 92.1550. And then if you had swap points or forward points equal to 70/80, then you would not have added 70 paisa. You would have added only 0.0070. So the PIP points are 0.0070, and if these two numbers are given, this will be added in the last two decimals only, and your new currency price would be 92.1095 and 92.1630. So you have to take care of the PIP points here in order to ascertain what would be the forward rates. So swap points could be given. So we have discussed that if swap points are increasing from left to right, these are to be added. And if swap points are given, let's say 40-30, these are to be subtracted in the spot to find out the forward price or forward exchange rate. There is also a concept of broken period. Let's take a simple example. Once again, let's take euro to 1 euro is equivalent to, let's say, 110 rupees. Okay. Let's give bid and ask 110 and 110.50. Now, swap points for 2 months are given as 40-80, which means after 2 months, 1 euro would be equal to 110.40 oblique 111.30. But if we want to find the price or the exchange rate after 1 month. So we will use interpolation. We assume that it will follow a linear path. And we'll use interpolation. Or this will help us find out the price in the broken period. So if the total movement in 2 months is 40, in 1 month it will be half of the 40 and half of it. So the swap points for 1 month you might get as 20, 40, and therefore the exchange rate after exactly 1 month would be 110.20 oblique 110.90. You may also find out the foreign exchange rate maybe after, let's say, if this is entirely 60 days and you are transacting on 35th day. So you can also calculate the foreign exchange at the 35th day. So this will be called as the broken period interest, broken period rate. So for 35 days, you will say that it is the total movement of 40 is there in 60 days. So how much would be the movement in 35 days? This will become the swap points for the bid. And similarly, 80 divided by 60 into 35. So this will become the swap points for the ask. So 35, it will be 23 roughly. And similarly, 80 divided by 60 into 35. This will be 46.67 or 47. So if you want to find out what is the exact foreign exchange rate after 35 days, 110.23 and 110.97. This is the foreign exchange after 35 days. Similarly, had it been 80-40, you will subtract. So under 80-40 also, when you see that the new swap rates after 2 months is 80-40, the new price would have been 109.20 oblique 110.10. And if 80 points are subtracted in 2 months, how many points would be subtracted after exactly 1 month? It would be 40. So it would be 109.60 and 110.30. Similarly, for any broken period also, you can count how many number of days are there and you can interpolate and find out what should be the exchange rate in that broken period. Now, how do you find out which currency is at premium and what is the percentage premium? So once again, if I take the example of euro, 1 euro was 110.00 oblique 110.50. After 2 months, if the forward rate is 110.80 oblique 111.50, that means euro is at premium. We have seen that the price of euro has increased. Earlier it was for 110, now it is trading for 110.80, indicative that euro is at premium. Now, what is the percentage premium? That would be forward minus spot divided by spot into 100. So let me just calculate for the bid. What is the percentage premium for the bid? It is 110.80 minus 110 divided by 110. So the euro is at premium of 0.8 divide by 110 into 100. So it's 0.7273% premium. But this is not annualized, it is for 2 months. Generally, the premium percentages are expressed annually. So if this is the movement in 2 months, I'll multiply it by 6 to find out what is the annualized premium. So euro is increasing at 4.36% per annum. Does it mean that rupee is at discount? The answer is yes. If euro is at premium, rupee is at discount. Is rupee at a discount? Of 4.36% per annum? The answer is no. The rupee is not at a 4.36% discount. Euro is at a premium of 4.36% per annum, but rupee is not at a discount of 4.36% per annum. For this, there are two ways in which you can calculate. Either you can calculate 1 upon 110, the indirect quote for rupee, which is earlier the rupee was at 0.009 and now it is 1 upon 110.80, which is 0.00902.5. So we have seen that rupee, which was available for 0.00909, it has now gone to 0.009025. The price of rupee has decreased. How much is the change? So now you will calculate the same. Forward minus spot, divide by spot into 100. Your answer will now be in the negative. It will be minus 0.0000647 upon 0.009090. The negative sign is indicative that the rupee is at discount. So the discount is 0.7150% for 2 months. And if you will multiply it by 6, you will get 4.29%. So there is a slight difference in how much is the discount in rupee as compared to how much is the euro is at premium. This either you can take the indirect quote and then calculate forward minus spot by spot, or you may also directly calculate the discount at rupee by using forward minus spot divide by forward using the direct quotation only. So once again, you will have 0.80, but this time 0.80 will not be divided by 110, but will be divided by 110.80. So you'll get the same answer. And this will be comparatively easy for you to calculate, right? So you get the same answer as how much is the discount. Maybe slight difference because of the rounding off, otherwise you get the same answer. And this will be If you follow this method, if you get a negative, that means it is at discount. Or if you divide by forward for the numerator currency, that means the numerator currency is at a discount. So this is how you calculate the premium percentage and the discount percentage. For discount, I'll take you a very simple example. For example, rupee by dollar is 50. And then rupee by dollar becomes, let's say, totally 100. So how much is the premium? If you follow the formula of forward minus spot divide by spot into 100. Let's say this is annualized. So 50 on 50. So the premium is exactly 100%. But if you will take the indirect code, you will have 1 by 50, which is equal to 0.02, and you will have 1 by 100, which is equal to 0.01. Now the discount on rupee 0.02 minus 0.01 divided by 0.02. Or if you use forward minus spot, you can say 0.01 minus 0.02. And as this is in the negative, 0.01 upon 0.02. You can say that the rupee is at discount. How much? 50%. But if you had used the direct quote only, your formula would change. Forward minus spot upon forward. 50, 100 minus 50 divide by 100. Then also you get 50 by 100, which is 50%. So when you clearly see this movement, when you have a small fraction, you don't clearly see that the premium on dollar is not exactly as discount on rupee. The premium on dollar was 100%, but the discount on rupee was only 50%. So there are two ways in which you can calculate. Either first go by the indirect code and then calculate the percentage of discount using the same formula. Or else you can use the direct quote itself, but instead of dividing by the spot, you will divide by the forward. You will take care that if this was positive for US dollar, that means dollar is at premium. Here, that means rupee will be at discount. So an exporter always fears, remember this thing very well, that exporter will fear that foreign currency does not depreciate or should not be at a discount. Whereas the importer fears the increase in foreign currency. The foreign currency should not be at premium. Okay. So these are the two important things because the exporter will be receiving the foreign currency and importer will be paying the foreign currency. So if you are receiving something and it depreciates, you will receive less. Your asset value will decrease. And if you have payables, you fear the increase in currency. That means your liability will increase. So these are the two concepts here. Now, if we look at the one more small concept of nostro account, we have nostro accounts, vostro accounts, and loro accounts. And once in a while, you do get questions on them. So first you understand what is a nostro, vostro, and loro accounts. I hope the basic concepts so far are clear. Let us talk about nostro account now. It is our account with you. So I'll talk it from the Indian perspective. Let's say SBI, the State Bank of India, wants to keep a Nostro account or has a Nostro account with, let's say, Citibank in US. So what does it mean? That the SBI has kept US dollars in Citibank US. So when an Indian bank has an account in another country and has kept dollars or that foreign currency in that bank, that is called as a Nostro account. Now, if a client of SBI or a customer of SBI is an importer, he wants to make the payment of dollars to his US exporter. He will approach SBI and SBI will ask Citibank to make the payment to the US exporter on behalf of his customer of SBI. So I hope Nostro account is clear. Account which an Indian bank is having with a foreign bank in foreign country in dollars. It facilitates making the payment on behalf of the Indian customers in US. Similarly, you may have the Nostro account and you may have a Vostro account. What is Nostro account for India is a Vostro account for Citibank also. Vostro means your account with us. So similarly, as SBI has kept dollars in US with the Citibank, Citibank, if it keeps rupees in India with SBI, that is a Vostro account for us. Citibank keeping rupees in SBI bank in India is the Vostro account for India. And for Citibank, they can say that they have a Nostro account. Then what is a Loro account? Supposing a customer is of Indian bank and Indian bank doesn't have a Nostro account with any other bank in US. Indian bank, I don't mean, I specifically named Indian bank. Let me change it to, let's say, South Indian Bank. So the India has a South Indian Bank. Now, South Indian Bank doesn't have any account, any Nostro account in US with the bank in US. But a client or a customer of South Indian Bank also wants to make a payment to a US exporter. So the South Indian Bank approaches SBI and it asks the SBI, makes a request to make the payment on behalf of its customer. SBI then contacts the Citibank in US to make this payment. South Indian Bank will make the payment to the SBI within India itself. So your account with them. Loro is, please make the payment through your account with them. So then we have a third party. So SBI only acts as an intermediary. So a bank which has a Nostro account acting as an intermediary, that is a South Indian Bank is using the Loro account. So that is the concept and it facilitates making payment cross borders when you have the Nostro account or Vostro accounts to receive payments from people outside India. Now, when you talk about these accounts, there are two concepts here. One is an exchange position and the second one is a cash position. So when you talk about exchange position, for all the purchases you get credit, and for all the sales you are debited. And cash position will move only when there is an actual delivery. But exchange position will be changed even if you have a bought forward contracts or any other transaction or contracts through which you make a deal. So exchange position moves with forward contracts also, plus with cash movements also. But cash position moves only with the actual delivery. So let us look at this question through which you will be able to understand how the Nostro account works. Suppose you are a dealer of ABC Bank and on 20th October 2014, you found that your balance in the Nostro account with XYZ Bank in London is 65,000. Okay. And you had an overbought position of 35,000. Right? So on 20th 10 2014, you had an exchange position. So purchases and sales and cash position. You had opening cash of a credit balance of 65,000 pounds. So you have a Nostro account in London with XYZ Bank where you have kept pounds. 65,000 pounds is the cash position. The balance in the Nostro account is 65,000 pounds. And there is an overbought position of 35,000 pounds in the exchange. After this, following transactions happen. You purchased a demand draft. This will impact the exchange position. You purchased a bill. This will impact the exchange position. Then you sold a forward TT. This will also impact the exchange position, but it is a sell transaction. Then your forward purchase was cancelled. That is equivalent to sell, which is 15,000. And there was a remittance by TT. This will exchange impact cash position plus exchange position both. That means payment has gone out. And the draft on London draft cancelled. This will only impact the exchange position. So let's see, we see only one cash position, remittance by TT 37,500. So what is your cash position now? You will have a balance in the cash of 65,000 minus 37,500. It is 27,500. So your balance is 27,500 pounds. And if we look at the exchange position, but we want how much to be the cash? We want the cash to be, what steps would you take if you want to maintain a credit balance of 7,500? We had 27,500. So you will sell the pounds of 20,000 so that your credit balance is only 7,500. Now let us look at the exchange position. 35,000, then purchase 12,500, purchased DD purchased the bill, $40,000, then sold forward TT 30,000, and forward purchase contract cancelled 15,000. And then you have remitted by TT 37,500 telegraphic transfer. How much? It was 37,500. This transaction has impacted both the cash position as well as the exchange position. And finally, draft on London cancelled 15,000. So draft on London cancelled, draft has been cancelled is equivalent to purchase. So now if you look at the balance, you have a balance of, but this 20,000 which has been sold to make the cash position of credit balance of 7,500, this sold will also come here. Sold cash, sold pounds 20,000. And now if you will look at the balance, how much is the balance? Let's see. 47, 87,500 and 1,02,500, 45, 1,02,500, both sides, which means the cash position is zero. Exchange position is zero and you have a cash of 7,500. So what was required is, what steps would you take to maintain a credit balance of 7,500 in the cash position? So we had a balance of 27,500, but in order to maintain only 7,500, we sold the pounds 20,000. These 20,000 pounds sold also impacted the exchange position. And how much is the exchange position required? We want to keep a overbought position of 7,500. But after doing all this, the exchange position is zero. So if you want to keep a overbought position of 7,500 pounds, of, yeah, 7,500 pounds. So you will buy pounds forward of 7,500 pounds, a forward contract of 7,500 pounds in the forward market. If you will buy it, actually the cash position will change. It will become 15,000. So we cannot buy the pounds. We have to buy only the forward position in the pounds, so that there is an overbought position of 7,500. So you started with an overbought position of 35,000, but now you have an overbought position of 7,500 only. Similarly, your opening balance was 65,000 pounds credit, but now your closing balance is 7,500 pounds credit. Okay. So this is how you have to ensure to calculate the balance in the Nostro account. And if anything is specifically required that you have to keep this, then you must take that position again. If you have to reduce your credit balance, you can sell. If you have to increase your credit balance, you can buy. So in this question, if instead of saying 7,500, had it been said that you have to keep a credit balance of 35,000, then we are short. We would have bought the pounds by 7,500, and this would not have impacted here. It would have impacted on the purchase side, the exchange position. Okay. Now, before I proceed further, we have seen that the exam paper has changed a bit, like the level of difficulty can increase. So that for that, it is important that you read the content very carefully. Each and every word matters. So let us discuss a few questions from our study material, and let's see whether you have been able to have a hang of it or not, whether you were able to come across these concepts. So for example, a football sells for 1,000 rupees in India. The transportation cost from Ludhiana to New York cost rupees 200, and the import duty levied by the US on cricket bats is 300 per football. Then what is the sectoral constant for adjustment? What would it be? If we look at the purchasing power parity, then it was spot into inflation in India and inflation in US, okay, in the foreign country. Now,
Madam,
yes, sir.
Here there is some contradiction. If football is there, then there is a cricket bat. I think,
Okay, sorry, sir.
yeah, please correct it.
I'll get. Thank you, sir.
Yeah.
A football sells for 1,000 in India. Transportation cost is 200, and import duty levied on the football is rupees 300 or rupee 300 per football. Okay, I'll just cancel this. Import duty levied by the US is 300 per football. Then the sectoral constant for adjustment would be what? So we have also come across a sectoral constant. So what does purchasing power parity indicate? It indicates that there would not be any transaction costs. We will only take the inflation in domestic country and the inflation in the foreign currency. Some transaction cost, movement, and any import duty, export duty will not impact the purchasing power parity. So the forward rate will not be impacted by that. But if they are, we will use a sectoral constant. So how to calculate the sectoral constant? So if the football is selling in India for 1,000, at what price would it be selling in US if we consider the import duty also? If we consider the transportation costs also. So then it would be 1,000 plus 200 plus 300. So we will apply the sectoral constant at 1,000 divided by 1,500, and that comes out to be 0.667 or 6667. So this would be our right answer. This is the sectoral constant. So while you are doing the purchasing power parity, if you are given transportation cost, import duties extra, please apply the sectoral constant. After that only you will be able to apply calculate the forward rate using the spot rates. Second question is the methods available for forecasting exchange rate. What are the methods which help us forecast what are the exchange rates? So they can be categorized into four general groups. What are these? Technical, fundamental, market-based, mixed, or fundamental, technical, market-based, or geopolitical, fundamental, market-based, research-based, and mixed, or moving averages, exponential smoothing, ARIMA models, ARMA model. So what is the methods available for forecasting exchange rate? How can we categorize into four groups? The right answer is technical, fundamental, market-based, and mixed. So technical will take into consideration for forecasting what was the historical price, how they are moving. So this will take into consideration only the recent past. Fundamental will take all the fundamentals, the geopolitical movements, and other important information regarding the exchange rate. Market-based will be based on demand and supply of the foreign currency. And the mixed will take into consideration all the other factors and take a combination of the three, and then we'll be able to predict the or forecast the exchange rates for the future. The third question is the international division of any bank calculates the merchant rates for a variety of transactions like import bill, export bill, inward and outward remittances, etc. And it advises the same in the morning with standard spread loaded to all branches. So you must have seen that when you go to the banks, you have seen there that the price of dollars, euro, pounds, they are being displayed in the banks. How these rates come to these banks? So these are the merchant rates for various transactions. And this advice, the international division of the bank will calculate this. And this advice reaches these branches in the morning and spread is loaded to all the branches, a margin or a spread which they will charge to the merchants. This is it called an exchange rate, standard rate, card rate, or spot rate? So the correct answer is this is called as card rate. Until and unless there is extreme volatility in the market because of any particular event which has created extreme volatility, these rates remains constant in that particular day. So they are sent to the branches in the morning by the international division of the bank, and that remains constant for that day. That becomes the card rate for that day. So there is a rule in the FIDI rule book regarding settlement of all merchant transactions. So for the merchant rates, some rules are still applicable. These rules, as per these rules, if the spot rate is USD equal to INR 92.2458 oblique 92.3402, and there is an exporter who has contracted for 500 US dollars with the bank, how many rupees are involved in this transaction? So firstly, you have to see that you are dealing with an exporter. This exporter will have exported certain goods to the US and must have received dollars. So if he has received dollars, he will sell these dollars to the bank. He doesn't need dollars. He is operating in India, so he wants rupee. So he has to sell these dollars to the bank. Therefore, bank will buy these dollars and bid rate would be applicable. So the applicable rate for us is 92.2458. So the bank should give him 500 multiplied by 92.2458 rupees. If you multiply 500 into 92.2458, the amount of rupees that the bank will give him is 46122.90. So is this the right answer? No, because this rule book says that any rupee must be settled to the nearest. So you have to round off, and if you round off this, you get the answer nearest rupee 46123. So the bank will pay him 46,123 rupees. So when you're doing the questions also in the exam, you can round off when you come across rupee payment or rupee receipts. One question. When the first dealer is happy with the ask. So what happens is, if a dealer asks another bank to make a quotation. So this is interbank. These are interbank quotes. One bank making a quotation to the other bank. The difference is when banks make merchant quotes, they load it with the margin. So in the bid as well as in the ask, they will put some extra margin. In the sense, ask will be added with the margin and bid will be reduced with the margin. But interbank quotes do not have margins. But if a dealer is asking for an interbank quote, the dealer is not expressing whether he wants to buy a particular thing or sell. So the bank doesn't know whether the dealer wants to buy or sell. So the bank will give both the rates, bid as well as ask. So let's say this dealer again asked for the dollar rate, and the bid was given as 92 and the ask was given as 92.20. So it's 92.00 rather and 92.20. We don't know whether the dealer is going to buy or sell. Now, how will the dealer, if the dealer wants to buy, he has to accept 92.20. If he wants to sell, he will get 92.00. So let's say the price was for $1 million. The quotation is received as 92.00 and 92.20. So when the first dealer is happy with the ask price given by the second dealer, which is 92.20, he or she would convey what? Which means I am buying $1 million from you. Will he say, you sell $1 million and I'm buying $1 million from you? If the first dealer had actually wanted to sell $1 million and he has asked a quote, and if he's happy with the bid quote, dealer wants to buy, he's happy with the ask quote. Dealer wants to sell, he's happy with the bid quote. Then what will he say? What will he convey? Which will mean that I am selling $1 million to you. So will he say, you sell, I sell? Will he say, I buy, I sell? Like he is buying and selling? Will he say, you buy, I sell? Or will he say, one mine, one your? So the terminology that is used here is one mine, one your. So when the dealer is happy with the ask and the price given by the second dealer, he will convey one mine, which means he wants to buy at 92.20. And if he says one your, it implies that he is wanting to sell $1 million. And as per the quote, he is ready to sell it for 92.00. Okay. All right, team, students, we can take a small break of 10 minutes and then we can continue again with this session. where I'll be discussing the questions which were asked in the last previous exam, the recent exam that was held in AFM, right? So let's keep a short break of 10 minutes and come back again. Okay. Last exam, first we had a case scenario which was based on Forex. Let's look at this. So Green Agro Export Limited entered into a 3-month forward contract on 1st January where it wanted to buy US dollar 200,000, 2 lakhs for an import payment which is due on 1st April. So if you look at the time period from 1st January till 1st April, you have Feb, March, April. So it is a 3 months period. Okay. So in the 3 months period, and second important information is that the person is an importer. So importer needs to buy USD 200,000. From this information given below, we have to choose the correct answers. First, we look at the information that is provided here. It says 1st January, 1st February, 1st March, 1st April. So the payment is to be made on 1st April and today is 1st January. So if you want to enter into a 3-month forward contract and the rate applicable would be ask. So you would have done a contract for 200,000 into 84 rupee per dollar. You would have entered into a contract for 1 crore 68 lakhs. So this is the first thing, 1 crore 68 lakhs. So Green Agro Exports Limited entered into a 3-month forward contract on 1st January to buy US dollar 200,000 or 2 lakhs. So when you multiply 200,000 into 84, your contract is for a payment of 1 crore 68 lakhs, right? Or 16.8 million. Now let's look at the first question. Green Agro Limited entered into a 3-month USD 200,000 forward contract on 1st January 2026. Something happened. On 1st March 2026, what is the maturity settlement cost plus net extra cost of closing original and rebooking 1 month forward? So what is happening? On 1st March, you decide to close the original. That means you will be required to make a payment of 1 crore 68 lakhs, but you will have to rebook the original and rebook again for 1 month. So when you are doing it, rebook 1 month forward. So when you are booking the 1 month forward on 1st March, you will look at the rates which are applicable in 1 month forward rates in the month of March. That would be the rates which will be executed on 1st April 2026. So what is the question? Extra cost of closing the original and rebooking 1 month forward. Now, if you look at the closing the original and rebooking 1 month forward. So what is the rate now for 1 month forward? How much is it? The difference in these two rates. It is you have to rebook at 84.05 and you will have to buy from market 83. Sell it in the market at 83.70. The difference is 0.35. Now 35 paisa per dollar. So 200,000 into 0.35. This will be your extra cost, 70,000. So if you are honoring the contract on 1st March itself, you are getting 1 crore 68 lakhs dollars, which you will sell in the market at 83.70 and again book a 1 month forward contract at 84.05. So the difference in the two rates are 35 paisa and 35 paisa into 200,000. 70,000 is what you'll have to pay extra. So what is the answer? What is the maturity settlement cost, which is 1 crore 68 lakhs, and extra cost is 70,000. 0.35 multiplied by 200,000. So C would be the answer. Is it clear? Next question. If the import obligation is settled early on March 1, 2026, what total cash outflow will be required that day to close the forward contract and make the import payment? So you want to close the forward contract and you also have to make the import payment. So you will need to honor this contract and you will have to make a payment of 1 crore 68 lakhs. But what will happen on 1st March is that you look at on 1st March, what are the rates prevalent? 83.7, 83.40 is for the spot, 83.75 is for the spot, 83.70 is for the bid 1 month forward, and 84.05 is again 1 month forward. So the question is, if import obligation is settled early on 1st March 2026, what total cash outflow is required that day to close the forward contract and make the import payment? So if you look at this price, 84 is the price at which you settled, whereas on 1st March, the price is 83.70 for 1 month forward. So when you have to close the forward contract also, you will take a forward contract to rather buy. Now that forward contract will be available at 83.70. So you will buy at 83.70, but whatever the $84 you have got, you will be able to sell it for 83.75 if you are maturing the original contract on 1st March. So what is the difference? The difference is 0.05 and it is a gain. So that multiplied by 200,000. So the gain is of $10,000 rupees. Apart from that, you will have to get it in the market at 83.75. So 200,000 multiplied by 83.75, which is 1 crore 67 lakh 50,000, which you have to pay minus 10,000. The question is, you have received early payment. You have to make early payment. Import obligation is to be settled on 1st March 2026. But your contract was for 1st April. So what you will do, you will buy from the market at 83.75. But for the contract which you have to honor on 1st April, you will have to enter into a forward contract at 83.70. So you'll buy at 83.70 and sell at 83.75, which means a gain of 10,000. Therefore, you have to ultimately pay 16 crore, 1 crore 67 lakh 50,000 minus 10,000, and which means the right answer is 1 crore 67 lakh 40,000. The third question is, Green Agro Export Limited cancels the import. He cancels the import and closes the US dollar 200,000 forward contract, which he entered on 1st January at 84 hours. So this we have already calculated that the contract would be for 84 hours. Now, if you read all the three questions, you will find out that if you have done this calculation in the first part that you have to buy at 84 hours, even if that solution is also verified here in the third MCQ. Now, what is the mark to market gain or loss on the following dates? So when you enter through a exchange, you have to, in a future contract, there is a mark to market. So what is his gain or loss if it is mark to market when you cancel it? So something which you had bought for 84 is now can be sold for 83.95, right? If it had been cancelled, there would have been gain loss of 10,000. Okay. So what is the difference in the price? 84 and 84.35, 83.95. Then on 1st February, on 1st March, and on 1st April. So you see that there is a gain here. The same thing is available at 84.35. The same thing is available for 84.05. And the same thing in April, you will look in the spot market. So he cancels the import, closes the US dollar forward contract, which he entered on 1st January at 84. And what are the mark to market gain or loss on the following dates? So you will look at this, there will be a gain or loss. So what is the first date? 1st February. Okay. On 1st February, what has happened? If you do the mark to market, he has bought for 84 and he will be able to sell for 83.95. So there is a loss of 0.05. 0.05 into 200,000. Because on 1st February, you will see there will be a 2 months period, right? So he has to look at forward price for 2 months. This is what he will look. Buy at 83.95 and sell at 84. If he cancels it on 1st March 2026, then there is a 1 month period. Okay. So here you will look at 83.70. So it is 83.70 and 84. There is a gain of 30 paisa per dollar, and 30 paisa into 200,000, 60,000. And then when he moves to April, in April, if he cancels the forward contract, he will sell at 84.20. So in April, there is a gain. April, there is no forward, it will be spot. I'll tell you again here. So this is the original contract for which he will buy. But if he cancels it, then on 1st February, he will have to sell it at 83.95 because there are 2 months. If he cancels it on 1st March, he will have to enter a forward contract for 1 month, and their difference is 30 paisa. And if he cancels it on 1st April, he can buy from here and sell in the market at 84.20. So here there is a difference of 0.05, then there is a difference of 30 paisa, and then there is a plus 20 paisa. When you multiply it by 200,000, the amount comes out to be 10,000, 60,000, and 20.20 into 2 lakh 40,000. So in Feb and March, there would be loss, and in April, there would be a gain. Okay, so he will lose 10,000 in February, 60,000 in March, and in April, he will gain plus 40. Okay, all right. Let us take up after the case scenario. Let us take up this question. This one is full length question for I think 8 marks or so. Where again we will talk about the foreign currency being involved. So Bharat Infrastructure Limited is a premium Indian engineering firm. They have been invited to establish and operate a high-speed data center infrastructure in the Republic of Valoria. So you are an Indian engineering firm and you are invited to establish and operate a high-speed data center infrastructure in the Republic of Valoria. Initial investment will be 4,000 million Valors. So the Valorian currency is Valors. Initial investment is 4,000 million Valors. You will operate a high-speed data center infrastructure in this country, and investment is 4,000 million Valor. Under the agreement, PIL will sell the project back to the Valorian government after 4 years with a guaranteed sale price for 8,000 million Valors. So initially, India will have to invest 4,000 million Valors, and then after 5 years, they're going to get back the 8,000 million Valors. And there will be a 4-year operational period. BIL will provide technical maintenance, security protocols, and will charge 80 million Valor payable at the end of each year. So far, 4,000 is gone. 8,000 will be received, all in millions, after 4 years. And 80 million will also be received from 1 to 4 years. To hedge the foreign exchange risk associated with the initial capital investment. So initially you are investing 4,000 Valors, you'll convert it into rupee. That's your initial outflow. There is no risk here. Why? Because the price that will be applicable to convert the Valors to rupee is spot. However, this payment is coming after 4 years. This payment is coming every year from 1 to 4 years. So, to hedge the foreign exchange risk associated with the initial capital investment, the BIL's investment bankers have proposed a currency swap arrangement. So, currency swap says 4,000 million will be swap, principal will be swapped in 0 year at today's spot, which means when the uh, Valorian Republic of Valoria will make the payment of 8,000 Valors, so 4,000 Valors will be exchanged at current spot rate. There will be no fluctuation in the spot rate. And the swap will be reversed at year 4, both parties re-exchanging the same principal amounts at the same spot rate locked at the inception. But we are going to receive 8,000 Valors. So out of 8,000, 4,000 is hedged because against the currency swap. The bank will also charge an annual facilitation fee of 0.30% calculated on the principal amount, which will be payable at the end of each year. So you have entered into making a high-speed data center for a bank in Republic of Vellore. So they will charge a facilitation fee 0.30 on the principal amount. But this 0.30 will be payable at the end of each year, and the currency swap will cover only the initial investment and terminal principal. BIL's policy is to hedge all other foreign currency cash flows using forward contracts at the forward rates prevailing in the market. So this 80 million will be at forward rates. Out of this 8,000, 4,000 would be currency swap and 4,000 would be at uh, the forward price after 4 years. And the bank is charging annual facilitation fee of 0.30 on the principal amount payable at the end of year. So the principal amount that is payable at the end of year is 8,000, and 0.30 will be applicable on 8,000, which will be payable at the end of each year. Okay. So it will be applied on the principal amount, which is paid in the end, but it will be 0.30% and it will be payable at the end of each year. Further, so far this is clear that 4,000 valors will go right away, 8,000 will come after 4 years, out of which 4,000 will be at the spot rate and 4,000 will be at the forward rate of fourth year. Plus, every year you will get 80 million valors, which will be converted into rupee at forward rates at the end of each year 1, year 2, year 3, year 4. But you have to pay a facilitation fee, which is 0.30 of the principal amount. This will also be payable at the end of each year. So two payables, rest receivables. The financial data is given here. The exchange rates are given 50, 53, 56.18, 59.55, and 63.12. Exchange rate, this rupee per valor. You have to calculate the cumulative present value. You have to calculate the present value. Discount rate adjusted is 14%. PVIF factors for that are 1, 0.877, 0.769, 0.675, and 0.592. You have to ignore tax and required to evaluate the financial viability using NPV method with all cash flows expressed in Indian rupees. So the calculations has to be done using Indian rupees. So first, let us calculate initial outflow of this company. It is 4,000 million valors which we have to pay or invest. And the exchange rate is 50. So 4,000 multiplied by 50 is 4,000. It's the rupee versus valor. Rupee is premium currency. It's 80 million. So in the initial year, as the exchange rate rupee per valor is 50, so 4,000 valor will be 4,000 divided by 50, 80 million rupees. Second, you will have to calculate the annual fees received. So year 1, 2, 3, 4. Fees is fixed at 80 million. Cash flows in Vellore and exchange rate 53, 56.18, 59.55, and 63.12. So cash flows in INR 80 divided by 53, 1 point, I'm rounding off to 4 decimals. One point 5094, 80 divided by 56.18, 1.4240, 80 divided by 59.55, 1.3434, and 80 divided by 63.12. It's 1.2674. So these are your 4 years cash flow. Then you also have to calculate the fees that is to be paid every year, 0.30 on the principal amount. So principal amount is I'll take it here only. Facilitation fees, it's 0.30% of 80 million. So 80 into 0.3. So it's going to be 0.24 million every year. It has to be 0.30 of the principal amount. Principal amount in rupees is 80 million. So I can directly calculate 0.30 into 80 million. Alternatively, I could have calculated 0.30% of 4,000, and then we would have converted into the Indian rupee. But it is saying that the bank will charge an annual facilitation fee 0.30, which is calculated on the principal amount every time. So it's not that the exchange rate will impact it. So the principal amount is 80 million rupees or 4,000 million Vellore. So it will be applicable on 0.30 on 80 million always. So it will remain 0.24 million, 0.24 million in all the 4 years, because the principal amount will not change with exchange rates. The principal amount was paid when the exchange rate was 50, and this percentage is applied on that. So your net cash flows in rupee, in million, in 1 to 4 years. So this is an outflow. So the bank will pay you the 80 million Vellores every year, converted into rupee. With the exchange rate changes, it becomes this, but you will also charge a facilitation fee. So ultimately, you end up getting, in the first year, your inflow is 1.2694. Second year it is 1.4240 minus 0.24, 1.184. Third year 1.3434 minus 0.24, 1.1034, and finally 1.2674 minus 0.24. This is 1.0274. So these are the four inflows which you will get annually from year 1 to year 4. So initial year outflow is confirmed and the 4 years inflow is also confirmed. Now we talk about the terminal cash flow. The company will do a swap. $8,000 million valor. 4,000 is a currency swap. So 4,000 divided by 50, you will receive your 80 million rupee here. But another 4,000 million converted into the fourth year forward rates, 63.12. That is another 63.3713. Or to round off 1/4. 143.3714. All right. So you have initial investment, annual cash flows, terminal cash flows, PVIF factor at 14%, and you will be able to calculate the present value. So initial investment goes as year 0, year 1, year 2, year 3, and year 4. Zero year, the initial investment was 80 million rupees. Or I can write here rupees in million. First year inflow is 1.2694. One 1.1840, 1.1034, and 1.0274. Terminal cash flow was inflow of 143.3714. PVIF factors at 14% are given 1.877, 0.769, I guess. Let's see. Yeah. 0.675 and 0.59. So the present value of this will be 80 million only. The present value of the second figure would be 1 point. Give me a moment. Uh, point 1.2694 multiplied by 0.877, that is plus 1.1132, C3 rather, that is 1.1840 multiplied by 0.769, it's 0.9105, 1.1034 multiplied by 0.675, and it's 0.7448, and last 143.3714 multiplied by 0.592. One 143.3714 multiplied by 0.592, that is 84.8759. So the net present value, if you will add all this, you will get the net present value 84.8759 plus 0.7448 plus 0.9105 plus 1.1133, okay, minus 80. Okay, and you end up getting this NPV. Let's check the figures once more. 1 point. Let's see whether we have covered everything or not. Bharat Limited, Premium Engineering, we have initial investment for 1,000 million dollars. BL agreement project the government after 4 years with a guaranteed price of 8,000 million. During the 4-year operational period, BIL will provide technical maintenance and security protocols and will charge 80 million payable at the end of year. To hedge the foreign exchange risk, With the capital investment, BIL's investment bankers have proposed a currency swap arrangement, and BIL will swap the principal amount of 4,000 million for Indian rupees immediately at year zero spot rate. So 80 million will come and 80 million will go. However, for the remaining 4,000 million, we will have to calculate at the forward rates. The swap will be reversed at the end of 4 years, with both parties re-exchanging same principal amount and same spot rate locked at inception, and annual facilitation fee of 0.30 calculated on the principal amount. So 80 million into 0.30 is 0.24 million, 30%. This will also be payable at the end of each year. And the currency swap will cover only the initial investment and terminal principal. BIL's policy is to hedge all other foreign currency cash flows using forward contracts at the forward rates prevailing in the market. So these are the rates: 50, 53, 56.18, 59.55, and 63.12, and 1.877, 0.769, 0.675, and 0.7592. Cumulative PVFA for 4 years is 2.913, 14% risk. Evaluate the project's viability. There is one more way in which you can do, as you see that an annuity is created here for the 24 million. So maybe you can take the present values of these figures directly, and then from there you can subtract 0.24 multiplied by 2.913. Okay. So these are your uh, present values that you will get. 0.80 million is the outflow in 0 year, then 1.1133 million is the inflow, 0.9105 is the inflow, 0.745 is the inflow, 7448, and 84.8759 is the inflow, 143.37 into 0.592. When you will add up all this, you will get the net present value. We have taken the factors correctly: 1.877, 0.769, 0.675, and 0.592. 4,000 divided by 63.12 is 13714. So NPV is 84.8759 plus 0.7448 plus 0.9105 plus 1.1133 and minus 80. So NPV is plus 7.644 million rupees. And as the NPV is positive, what is the question asked? Should we go for the decision or not? So you have to advise whether the company should go for this arrangement or not, calculate the NPV, and financial data. You are required to find out the viability using the NPV method with cash flows in Indian rupees, rupee million. So we have calculated everything in rupee million, and the NPV comes out to be a positive 7.644 million, which is positive. Therefore, the project will be viable for BIL to go ahead and make the investment. Okay. Any questions here? So this was the question which was there in the last exam. It was manageable without any problem. If your concepts are clear, you will be able to do it. Next topic that we will be discussing is how to hedge the foreign exposure. One of the ways we have already discussed extensively is the forward contracts. The second method could be your future contracts. So in futures, the things are standardized. There are clearing houses which acts as intermediaries. The contract sizes are standard. In forward contracts is over the counter, where you can have a contract for maybe if you have to pay $27,322, you will have a contract for same amount. But in the future contract, like we have the standard size of dollars as 100,000. The pounds, the standard size of a contract is 62,500. So you will get the future contracts only in multiples of this. So if you have to make a payment of 5 lakh, 5 lakh, $3,200, you will be able to take 5 contracts. And you will be able to hedge 500,000 or 5 lakh rupees. But for 3,200, either you go for some other hedging option method, like you can take a forward contract for the $3,200, or you may decide to take the risk, remain unhedged. Similarly, in pounds, 62,500 into 2. If you have 1,25,000 pounds to pay, you will have exactly 2 contracts. But if you have 1,26,000 pounds to pay, you have to take the exposure for 1,000 pounds, or else you can cover it under some other method. The third is also money market instruments. Money market instruments are using the interest rates and taking the benefit of that. And alternatively, one more options are there in the derivatives, where you if you want to buy dollars, you can buy the call option on dollars for, let's say, 92. So if the dollars become 95 in the market, you can get it for 92. But if the dollars are 90, then you can obviously buy it from the market. So options don't bind you. Options give you the right whether you want to exercise or not. So if the things become in a call option, if the things get expensive, so the call option has a strike price. Let's say you can buy $1 for 92. Now, when the time comes to actually exercise the option, when you exercise the option, if that time the spot is 93, you will definitely exercise your call option, and you will be able to get your dollars for 92. However, if on the exercise date, spot price is 90, you will let the option lapse and you will buy the dollars from the open market in the spot. All you will have to do is to pay the premium. So you will lose on premium, but despite losing the premium, maybe your overall price will be less. So call options are exercised when the market price is higher than the exercise price. But if the price is less than the exercise price or the strike price, in that case, you let the option lapse and you will buy the dollars that you need as an importer from the market. Similarly, if you are an exporter, you need to sell. You will buy a put option. So if you buy a put option at an exercise price of, again, $1.92. That means whatever the money or dollars you will receive, you will be able to sell it in the market for 92. Now, if on the spot day, the price becomes the spot price is 93. Why will you sell it to the option seller at 92? You will sell it in the market at 93. However, if the spot becomes 90, you will definitely sell it to the option person at 92. So the call option becomes exercisable when spot price is greater than exercise price. And when spot is less than exercise price, you will buy from the spot market and the call lapses. You lose the principal on this, but you are secure. Similarly, for put option, if S is greater than X, you put option lapses because you sell in the spot market. But if a spot market is less than the exercise price, then you exercise the put option and you are able to sell it at the exercise price. So once again, if the market price, if the exercise price is 92 for both put and call, here you are buying a dollars as an importer. So if they are available in the market at 93, you will exercise the put of call option and buy the dollars for 92. But if they are available in the market at 90, you will buy it from the market. Similarly, in the put options, if you are an exporter and you decide to sell your dollars for 92, if market is buying them at 93, the market price is more than 92, you will sell your dollars in the market and you will let the put option lapse. But if the market price is 90, that means they are selling at less than 92, then you will exercise the put option and sell your dollars at 92 by exercising the put option. So you've seen how forward contracts work. You have seen, got an idea of how options work. Next, we will look at how the money market instruments work. So under money market, we try to utilize the benefit of interest rates. In the sense, let's say, first, let me take that you are a exporter. So if you are an exporter, you are going to receive a foreign currency, let's say dollars. And you are fearing, your fear is that price may not fall. So if you are a person who are going to receive dollars, from a foreign country, right? So if these dollars will flow back, if you have to pay them to some outsider, who's this outsider? He was the lender originally from whom you borrowed. So here you are going to receive the dollars, and whatever the dollars you receive, you will end up paying this to the lender from whom you borrowed. So if dollar is of 92, it doesn't matter. If the dollar is of 5 rupees, it doesn't matter. So 92 coming and going out and 5 rupee coming and going out, you are in exactly the same position. So if you are an exporter, you have an asset. So you must create a liability. Take an opposite position, create a liability. To create a liability, you need to borrow. So whatever the foreign currency you will borrow, convert it into local currency. Using spot rate. Spot rate will not fluctuate, so you will convert it into home currency and using the spot rate, and this you will invest or land. Now, after 3 months, 6 months, whenever the time comes, you will receive those dollars and repay. So the net outcome will be that whatever the amount you had in Indian rupee, that you will receive. Your investment or land in Indian rupee with interest. So let's take an example where, let's say, the rate of interest in India is 10% and the rate of interest in US is 5%. So you had 100,000 US dollars coming to you. So you create a liability by borrowing 100, create a liability by borrowing the present value of 100,000. You don't need to borrow 100,000. You need to only borrow the $100,000 coming after 1 year or coming after 6 months. So let's say these two interest rates are for 6 months. So it's too high as per the US and Indian perspective, but let's keep it just for the question. So you had 100,000 US dollars coming to you after 6 months. So you create a liability, and for that you borrow the foreign currency dollars. How much? The present value of this amount, applying the rate of interest prevalent in the foreign country. So you will borrow 100,000 divided by 1.05. You're going to borrow 95,238.09. Now convert it into the home currency. Let's say rupee dollar exchange rate is 92. So this makes into 92. Or if bid and ask are given. So you are going to buy the rupee. You are going to sell the dollar. You will get only 92. So you end up getting 87 lakh 61,905 rupees, rounded off to the nearest rupee. 87 lakh 61,904.76, but as per the rules, 87 lakh 61,905. So going to invest 87 lakh 61,905. So what will happen after 6 months? 6 months later, you will receive 87 lakh 61,905 rupees to the person whom you had lent or wherever you have made an investment, together with a 10% interest, which makes it 87 lakh 61,905. So you end up receiving 96 lakh 38,096. Now this is what you will receive. Plus you will also receive the 100,000 US dollar, which you will also pay. So you receive from your importer $100,000 and you pay to the person from whom you had borrowed. Also, the amount you invested in INR is 87,61,905. This also you will receive with 10% interest. So you're receiving $100,000, you are receiving 96 lakhs 38,096, and you are going to pay $1 lakh. So this will cancel out. So whether dollar is for 10 rupee, 15 rupee, 1,000 rupee, 80 rupee, 90 rupee, it doesn't matter. all is net that is there is you have received 96 lakh 38,096 rupees. So this 100,000, you were wondering that after 6 months, what if I receive only 92 lakhs? What if I receive only 89 lakhs if dollar depreciates? But now your inflow after 6 months is confirmed at 96 lakh 38,096, no matter what the exchange rate of dollar is, right? We'll repeat this from an importer's perspective. How an importer would utilize the money market hedge. Okay. So let's see. Let's keep the exchange rate at 92.1, 92 and 92.10. Let's keep the rate of interest in India and in US at 5% for 6 months. So if you are an importer, you have $100,000 payables and you fear that the price may not increase for dollar or dollar may not appreciate. But what if the move price in dollar stops impacting you at all? So being an importer, you have dollars payable. So what if you receive dollars from someone and you will make the payment there? So for receiving dollars, you have to invest or lend so that after 6 months, they pay you the dollars to which you make the payment to the US exporter. So to start with, if you are an importer with dollars payable, you have a liability. Therefore, you will create an asset. Asset will be created when you invest or lend, but you will not lend or invest complete. You will lend only the present value. So 100,000 is to be invested in US. 100,000 divided by 0.05. You will invest only 95,238.095. So you must have $95,000, 95,238.10, let's say, dollars. So you need this to convert it into rupees. By multiplying by, you have to buy the dollars. So you will have to pay 92.10 this time. Ask rate would be applicable. So 95,238.10 multiplied by 92.10. It is 87 lakhs 71,429.01. Ignoring that, you will now receive 87 lakh 71,429. Sorry. Excuse me. So you have converted the dollars you need to buy, and you will have to pay 92.10 rupee per dollar. So you will need to pay 87,71,429 rupees and buy $95,238.10, which you will lend it to someone in US or invest in US. Now, you don't have this much amount now. If you were having this amount, you would have converted it to spot rate today itself, and maybe you have made the payment to the exporter in US. But you didn't have the money, so you will have to borrow 87 lakhs 71,429. Now, after 6 months, what will happen? Firstly, you will have to repay the loan which you have taken in Indian rupees together with interest. So you have to repay 87,71,429 multiplied by 1.10. Secondly, this person where you have made investment in US, he will pay you US investment will fetch you 95,238.10 into 1.05, which is exactly $100,000. And you will make your import payments. It's coming out to be 100,000.005. So you make your import payments of 100,000. So this comes, and this goes. Net, your outflow in Indian rupees is fixed at 96,48,572. We'll make it round off, right? So no matter what is the price of a dollar, whether it is 1 rupee, whether it is 10 rupee, 92 rupee, or 192 rupee, your outflow is fixed at 96,48,572. So same perspective from exporter or importers view. Okay. So this is how money market hedge works. I'll quickly brief. If you have payables, liability, create a situation to receive exactly same foreign currency by investing the present value in foreign currency. Now, how will you get that foreign currency? Buy the present value from spot market using ask rate and borrowing in local currency. home currency. The amount required. So this is what you will do today. Payables, create a situation to receive exactly same foreign currency, $100,000. So create an asset by investing the present value of 100,000, 95,238 in foreign currency. So buy 95,238 from the spot market using ask. Then this is the amount you require. Borrow this amount in the local currency or home currency from your local country. After 6 months, repay this with interest. And whatever you have made investment in foreign currency will be received with interest as $100,000, and you can make your import payments. So all that will be outflow will be the local currency borrowed together with interest, no matter what the price of dollar is. Exactly opposite is, I'll read from this line. If you have receivables, create a situation to pay exactly same foreign currency by borrowing the present value in foreign currency. So once you borrow $95,238.10, what will you do with that? Convert it into the Indian rupee in the spot market using bid rate, and then invest it in the home country. After some time, you will receive this amount back with interest. So you'll receive receipts are fixed in Indian rupee that you will get with interest. And whatever the dollars you had borrowed, whatever the dollars you will receive from the importer in US, that you can make the payment to the person from whom you had borrowed in US dollar. So dollars will be received and they will go back. And all you will have to receive is the Indian currency together with interest. This is how a money market hedge works. So we are clear with forward, we are clear with money market hedge. To some extent, we are also clear with options. Let's look one case scenario for the money market hedge. There is an Indian exporting firm. So the moment you have an exporting firm, you have receivables. How much is the receivable? Australian $1 million to an importer in Sydney. So payment is to be made in Sydney. Now, when you have to receive the money, you are worried that the money may not depreciate. The Australian dollar may not depreciate. Otherwise, you will end up receiving less. So, and the time is after 6 months, 3 months. Rohit and brothers are worried about likely depreciation of Australian dollar in near future, as it is likely that the export sum will be received after 3 months. So if at present Australian dollar is of 70, you will receive 70 million, right? If you have made an export of 1 million, you will receive 70 million. But what if Australian dollar falls to 68? You will lose 2 million. That's a big loss, right? So today, as there is no derivative contract available, there is no derivative contract available at all. So the only option left then is money market. What is the spot rate? What are the 3 months rate prevailing in India and in Australia? These are per annum. So to find out the rate of interest applicable for 3 months, that is 1 quarter, it is 3% for 3 months. And 5 divided by 4, this is 1.25 for 3 months. From the following information, choose the correct answer. So first, let's solve this. Once again, Under the asset and liability, we have an asset. So we create a liability. To create a liability, you will borrow the present value of $1 million. So you will borrow 0.9876 million dollars, as bid and ask are not given. So to borrow these many dollars, when you will borrow, you will convert it into Indian rupees, which will be 0.9876 into 56. I have written here 0.9876, but maybe in my calculator I taken 0.987654,321. This multiplied by 56, the money amount I'll round off. It is 55.3086 million. I will invest at 3%. So after 3 months, I'll end up getting 55.3086 into 1.03. In my calculators again, I have my last digit also. So maybe the answers may be slightly different, but you will round off all intermittent digits also up to 4 decimal places, and then you will put the answer. But for the final figure of your rupees, you can round off till last rupee. So you end up getting 56.9679. Okay. What will happen otherwise? You will simply receive the US dollar, Australian dollars, and you will make the payment to the person from whom you have borrowed 0.9876 million. When you will multiply 0.9876 into 1.0125, that will come out to be exactly 1 million Australian dollar. So if I have to look at the questions, first question, which hedging technique can be used by Rohit Brothers to hedge itself against the risk of depreciation of Australian dollar? So forward contracts, future contracts, option contracts, all three are derivative contracts. These are three types of derivatives. And the question clearly mentions that there is no derivative contract. The option left to me is money market hedge. Suppose if Rohit and Brothers wants to borrow some amount in Australian dollar in such a manner that a receivable amount can be used to repay the amount borrowed along with interest. The amount to be borrowed by Rohit and Brothers shall be approximately, so we have calculated it is 9876. 0.9876 or Australian dollar 9,87,654. Why I had taken longer decimal places, not more than 4? Because already we are talking in million. So if you will multiply it with 10 lakhs, you will not take 0.9876. You will take the digits by multiply by 10 lakhs. So you should take at least 7 digits. 1 million has 6 zeros. So at least because you're talking of 0.9876 million, so at least take 6 digits. So that's why you will have this answer, 987,654. Now, they have borrowed 9,87,654. So suppose if Rohit Brothers borrows a designated amount in Australian dollar for 3 months in such a manner that the receivable amount can be used to repay the amount borrowed along with interest. And they want to plan to invest same amount in Indian spot market. What is the amount available for investment? So that will be what? The amount of $9,87,600 multiplied by 56. So you will be able to invest 55 million, 55.3086 million, 55.3086 million. Okay, so can't take smaller decimals or up to 4 digit or 5 digit. Because you're talking in millions, take up to 7, 8 digits. Then only you will be able to round up to the last rupee. Now, if they have borrowed the designated amount for 3 months in Australian dollar, so that the receivable can be used to repay the amount borrowed with interest, and further he plans to invest the same in Indian spot market, what amount would be obtained after 3 months of investment in rupees? So what will 55 million become? It will become 56.9679 million. 56.967882 million. So I had round, sorry. So the same amount available for investment is 55 lakhs, but it will become 56.9678 million. Now, if the interest rate parity theory held between IRR and AUD, what would be the forward rate? So its spot was 56. Forward is given by what formula? Spot into 1 plus rate of interest in domestic currency upon 1 plus rate of interest in foreign country. So 56 into 1.03 divided by 1.0125. Why this question is asked here, I'll let you know. 56.967901. When this is multiplied by Australian dollar 1 million, you end up getting 56 point. Let me check the calculation. Interest rate parity. So it's asking for 6 months. So 56 into 1.06 divided by 1.025. $57.91. But if I calculate for 3 months, the figure comes out to be 56.96. And when you multiply it with $1 million, you end up getting 56.9679. So when interest rate parity holds good, the outcome of money market hedge is exactly the same as forward rate contract. 56.967883, 56.96783. This 79 may be because of the rounding off, which we have done here slightly, right? That's why 56.9679 I have written here, but it was 788 something, right? 7882. Same here. If you round off, it is 0.79, otherwise it is 0.788. So this is to bring to the concept that if the interest rate parity holds good, the outcome of money market hedge will be exactly same as forward contracts. Right? So this is all for today's session. We'll continue with the foreign exchange as well as international financial management in the next session on Tuesday. Thank you so much, everyone. Bye. We can close the session.